fund managers at the moment are quite cautious given current market volatility. But as we know, caution in the market also gives rise to opportunities. This week I spoke to Haig Bathgate, who's co-CEO at wealth and asset management firm Tcam, who spoke to me about the sort of opportunities that can be found in the current economic challenges.
Yeah, I think it's a really interesting time, and we've seen a massive style rotation effectively in the first quarter. Coming into the year, investors were quite cautious, and we saw a number of the more cyclical areas like resources selling off. And then in February saw a huge rebound in those areas. So there's huge opportunities for active managers, for people who are willing to trade around this. But clearly if you're a longer term investor, you have to look through the noise, and you would have been either a hero or zero, depending on your positioning in the first month, and then that would have completely reversed in the second month.
In terms of portfolio opportunities then, as we go into the second half of the year, what is your view?
Well, our view is that the rebound that we've seen in the mining and resource sector, and the oil price in particular, is going to be short-lived. A lot of it is predicated on the back of what we've seen in China and some of the economic data improving a little bit. But all of that is through artificial stimulus, and the extent that investors think that artificial stimulus will continue is pretty clear from some of the announcements that we've seen in China more recently, that it's not going to be quite as significant as some investors had thought, and we would think that would continue to be the case. So we're becoming a little bit more cautious at the moment.
I know you went to China recently to assess the prospects and health of the Chinese economy, and of course elsewhere in Asia. Now if we talk about the Chinese economy for a moment, we are beginning to see some improvements in the economic data, but only in certain sectors, and China is obviously still continuing to struggle. Now, if we look at the bigger picture, what is your view on the sustainability of the Chinese economy right now?
Well, I think it was interesting in the back of the trip. I would say in the short term, I'm not overly concerned. In the medium term, I'm much more concerned than I was going into that trip. It's clear that China lurched back every time to fixed asset investment, to construction spend. That's what they've done in the past, and every time that the economic data starts to get weak, that tends to be the stimulus that they start to provide. Clearly, the rate that they're depleting the reserves at the moment mean that they can't do that with the same vigour that they have done in the past. And for that reason, in the medium term, we're becoming more concerned about China, and some of the misallocation of capital that we've seen, we think will start to manifest itself. It'll manifest itself particularly in the area of non-performing loans, and we can see there's been an evergreening of loans in China for some time now. But the debt to GDP ratio is now approaching 250%. It's doubled in the space of 7 years, and that can only be deferred, and the impact of that can only be deferred for a defined period of time.
What's your outlook on rate hikes from the Fed this year?
Well, we're watching it with interest. I think what's clear is central banks will change their views. They've shown that they're not scared to change their view when the economic data changes. We think the biggest risk in the US is an unexpected rate increase. There's basically no expectation from the markets that there's going to be a rate increase in June, but we think that the parallels with the early 90s are quite relevant here. We're starting to see wage growth pick up in quite a major way, approaching 5% at the moment. That doesn't directly feed into the inflation measure, but clearly as people start to earn more, then the consumption would likely increase. Consumption is 2/3 of the US economy, and therefore we think that the risk is that we see a rate hike in the US when the investment community are not expecting it.
When you say then that the market might not be expecting it, are you then expecting the possibility of a rate hike in June, or are you talking further down the line?
Well, I think the prospect of it coming in June, or maybe, again, unlikely, but quite soon after that, we think we could see unexpected rate hike. The one thing that's clear, if you look back to the early 90s, is they can change their mind very quickly. If there's a sense that inflation's coming back into the system and the inflation genie is getting out the bottle, they will react quickly, and they will react successively as well. So that could signal successive rate increases at a time where the stock market could still be suffering a little bit.
Now, moving on to the UK, we do have some concerns over the health of the UK economy from an economic point of view, and also the political situation at the moment, given the upcoming UK-EU referendum in June. Now, we are seeing a lot of selling pressure on the British pound, and given this layer of uncertainty, what's your view on the value of sterling going forward?
I think it will continue to be volatile in the coming months. Clearly we've seen a bit of a rebound in sterling just recently, on the back of a sense that probably the vote is going in the way of a non-Brexit outcome. But as we saw from the Scottish referendum last year, when you come into the eye of the storm and 6 weeks before the referendum, if it's getting close, as was the case in Scotland, as was the case in Quebec with the Quebec referendum as well, that's when it really comes into the sight of international investors. So I think if the prospect of a Brexit continues to diminish, it won't feed into sterling weakness. However, if that starts to become a more close run thing, then you could see quite a lot of volatility in sterling. I think when you look at the fundamental backdrop for sterling, a lot of that is predicated on what happens in Europe. Our biggest export partner is Europe, and if Europe continues to stabilise and improve, then obviously you would expect sterling to stabilise as well.
In terms of markets or trends then going into the second half of the year, is there anything else on your radar?
I think the rebound that we've seen in resources, we think will peter out. So we think the resource sector will continue to come under pressure like it has done this week. That has big ramifications for the UK market. The UK market is clearly 1/3 dominated by mining and resource companies. Probably some of the rebound we've seen in some of the emerging markets will not be as strong as we go forward. They're very dependent on resources, as we know as well. And we also know that if there is an unexpected rate increase in the US, or just even the expectation of rates starting to move up in the US, that's usually bad news for emerging markets. So we'd expect a bit more emerging market weakness, we'd expect a bit more developed market strength, but a continuation of the long-term trend, which is probably in favour of more developed Western markets at the moment.